Hey everyone, so today's topic of the video is talking about buying versus selling options. I want to take you through all the examples that I've been through in the past. This is basically just me dumping all my knowledge of the last 10 years of trading options into this one video or presentation, you can call it. And the idea is to like take you through the whole process of what buying options are versus what selling options are, and why we prefer selling options, and how the risk is aligned with buying and selling, or how the probability of profit is aligned with buying and selling. Meaning, how do you profit? What kind of probability of profit do you get with buying versus selling? And what kind of risk that you take, when you buy options or sell options? And also, more importantly, what is your probability of success when you buy options or when you sell options? The two different methodologies that we see in the markets. So let's get into it. So let's go through a slideshow here. It's all coming up. Okay, so why can you trust me, first of all? And that the reason for that is I've been doing this for the last 10 years. And I wasn't successful in the first few years of trading options, but once I figured out that buying options does not make much sense, it's the other side of the equation that you need to be, which is the selling side of things. So once I started selling options and I started doing some of the strategies really well, first of all, define risk strategies, and then moving on to undefined risk strategies, then things started to make more sense, and then it all started to come together. So I want to show you, if you're still buying options and you're not successful and it's not hitting your mark, or you're not being very consistent in the market, just try this method. Try selling options. But selling options, just keep that in mind that it comes with some risk, more risk than buying options, obviously. But then you also need to be actively involved when you need to be. So the way we trade is like we're not glued to the screens all day long. We have day jobs, other stuff going on. So we take positions 45 days out, and then we come and revisit them every now and then, at least once a day. And then if they do need some adjustment, or risk management or rolling or hedging, then we come and take up adjust them. Otherwise, the idea is to like keep the positions on, and then collect time decay, which is theta, in these kind of strategies. So what you will learn in the next 15-20 minutes, 3 bullet points. You will be able to distinguish between long and short options, and you should be able to see exactly how each makes money or loses money, and then should be able to follow a step-by-step checklist that I have here. Okay. Have I missed anything? No. According to me, this is what I've seen in the market. Most new traders lose money because they don't really understand whether they're taking a position for direction, or are they taking a position for income. Are you buying for a big move, or are you selling for time decay? That's the biggest difference I've seen in successful and not so successful traders. So we are going to break that belief, and try to learn how short options or selling options can be more profitable and more, in the long term, can grow your account. The risk and reward is another thing. Unlimited loss versus limited gain, or vice versa, whatever the situation is. This is what I've seen people mostly do in the markets. I was doing the same thing, to be honest. When I first started doing options trading, I was doing the same thing, but then eventually I moved on and started doing other things, other strategies, risk defined and short options, and it started making sense. Too many strategies is, again, not a good thing. So just keep that in mind. Too many indicators, too much fluff on your screen, too much clutter on your screen is not a good thing. So we keep things simple. We go with 1, 2, or 3 strategies max to start with in the defined risks category, and then we don't look at any indicators apart from 1 or 2. And then it's mostly about price action and taking the contrarian view on the market. Um, Again, this is simple. A few more bullet points. You can take a look at this here. The edge for us on the option selling side is the time decay that we get based on volatility and how the implied historical volatility versus implied volatility has worked in the past, and how we think about it working in the future as well based on current market conditions. So that's the main game. Okay, first of all, basic idea of an option. What is an option? Okay, it's a contract that grants you the right, but not the obligation. You're not obligated to do anything. You have the right to do something, but you don't have to do anything. Something. Okay. To buy when you buy a call, or you sell when you buy a put. So here's a simple example. When you buy a call at a certain price, let's say the stock is trading at a certain level, and then you buy a call here above the market. If the price goes through this call, you can get these stock at the price that you bought it at, the strike price. If you bought a put which is below the market, and if the market goes below you or below your strike, you can still sell those shares at your strike price. That's the basic difference. That's a call and a put option. Okay, when you buy these calls and puts, you pay a premium upfront. So that's the cost to trade. When you sell these options, you collect that premium. So it's basically the opposite or the reverse. That's the main difference. Buying options are usually used for speculation for short-term move. So, for example, if I was to take a bullish view on the market, and I think the market will go beyond a certain point within this time frame, I will go out and buy that option, for that time period. So if it's a weekly option, I'll buy that if my view is on the weekly market move. If my view is on the daily market move, I'll buy the zero days to expiration options. Some people do it for leverage, other people do it for hedging purposes. A lot of the big institutions, they buy puts and protection in the market for hedging purposes, meaning they're already very long somewhere and they want to collect some short delta. So instead of selling calls, they buy puts. It's an easy way to collect short delta and then, collect and then express your negative view on the market or hedge some of your positive views. Selling options is mainly for income generation. You keep doing this, you rinse and repeat, and then you collect some premium every time you sell an option. And as long as the underlying stays within your break even points, you make money whether the market moves up, down, or doesn't go anywhere. But if it stays within your range, you make money. Whereas on the long side or the buying option side, it has to go above a certain point. It has to go somewhere for you to make money. On the short side, it doesn't need to go anywhere. It can stay within a range. You can stay within a lot of different things, and then you can still make money. The short side is volatility, mainly a volatility play because you are shorting the vol, meaning when you sell an option, you are short the Vega component of the option Greek. And I'll show you more about these Greeks when we go on the platform, but this is where it is. Before we go on the platform and look at these simple option trades, I want to invite you to this free webinar that I'm running. The next one is on. Actually, this date is not correct, but the next one is on. Just you have to check the website when the next one is on. I'll put the link on the show notes, and then you can take a look. Basically, we will cover some strategies, some delta views, some Greek views, and just the overall gist of this option selling business, right? And how to get started, basically, what to do with it. That's the whole idea with this masterclass. So I'll post the link to take a look and check it out. Okay. Long call. This is theory, and then for practical purposes, we'll go to the platform and take a look at the same thing. So we pay a premium to buy the call. Let's say the underlying stock is trading at 48. We buy 150 strike call, which is above the market. So market is at 48. We are going 2 points above, and we pay $2 premium for it. So that is $200 in options world. So our max loss is basically the debit that we have paid, the amount of money we have paid. That's $200. The break even then becomes your strike plus your premium, meaning you you got a 50 call strike, and then you add $2 on top, that's 52. So now the stock needs to go from 48 to 52 at least for you to make money. That's $4. That's a $4 move, right? In percentage terms, that's, I don't know, maybe a 10% move, maybe a little bit less. So the only has to move 10% already for you to even start making money. That's the whole idea. Okay. Let's take a look at the long call here on the platform. This is my paper trading account. So, and the markets are, it's in the evening, on a Monday evening. So the markets are, obviously the futures markets are open. So you'll see these numbers move around, but the stock markets are closed. So none of this would move. Anyway, so if I were to buy an option, I would go really short term. I don't go long term. For example, Apple is trading as 200, and then you're buying a option at 28 delta. Look at this delta column, right? Look at this delta column. You're buying it at 28. You will hit the ask side, and the buy screen will come up. Just want to show you the P&L diagram of this. You are paying $2.18 for this option, which is at 210 strike. Did we select the 210 strike? Let's see. Yes, we did. 210. Okay. So when you select 210, you also need to make sure that you have. This is why it's. I need to take this off. That's why I have a paper trading account. I have 100 Apple position on, which I bought at 200 and still trading at that same level, basically. So you need to set your break-even points at where the expiration cycle is. So that's 621. So go back and select it there, and then look at the gray area here. The gray area is basically the expected move of this stock within this time period. So the market is expecting it to move within this time frame. It's expecting it to move to from here to there. That's all it's expecting it to move. So from the $200 strike price that it's currently sitting at, which is this marker here, the red one, it's expecting it to move 50% with a 50% probability that it will go up, and the 50% probability that it will go down. That's the whole idea here. And only if it goes beyond your strike plus the premium, you then start making money. That's the long call. Okay. Now let's jump into I think the next one that comes up is a long put. Again, a very simple example here. Let's look at the numbers first. You're buying a long put. The stock is trading at 48. You buy a long put at 50. Or whatever strike. This strike should be 48, not 50. That's not correct. But your break-even point will be the strike minus the premium now. So let's take a look at this. So if you were to go in and buy the Apple put at, again, the same delta, we selected 28. Let's try and find 28. If you cannot, let's do the 30. Hit the ask side, and then the put option comes up. And let's take this to the Analyze tab. Only put option is selected. Okay, great. So then change these, change that. Okay, great. Now also look at the probability of profit here. If you select this thing, 43% of the time, this thing is expected to move up in this range, and then 41% of the time, it's expected to move down in this range. So the range is basically 50-50 when you buy options. You don't get more than that. In this case, it's even less. Okay. So here's the strike. Oh, sorry. Here's where the underlying is trading at, which is 201, which we can also see on the screen here, right? Cancel this. Okay. The stock is trading at this marker. You have selected a strike of 195, and then you're also paying this much in debit, which is $2.64. Now you must have noticed that the puts are more expensive than the calls. We selected the same delta level basically, but the puts are always going to trade more than the calls because the puts are more in demand because people are buying protection here. So there's always a put skew going on in the major indices, major stocks. There's always a put skew. Sorry, in the commodities market, there's a call skew, meaning the risk is on the upside. So the market, you know, expects the underlying to go on the upside more than it expected to go down. Here is the other way around. It expects this market to go down more than it expects it to go up. So they buy protection here. When they buy protection, then you keep bidding up the price of the put and it becomes more and more expensive. And that's why you see a difference here, maybe a 50 cent difference, right? So this is a long put example, a simple long put example, nothing complex about that. Now let's get into the short call side of things. Now I want to show you the chart first. Now short call is same as buying a long put because it gives you the negative delta that you need, in the market. But your probability of profit changes from 40, 45, 50% to like over 80%, meaning you can make money 80% of the time in this trade. And how could that be? Let's check it out. So let's take all these out. If I were to take a short call position, I would go out and do it let's say we do it at the same strike, right? 210. We go out and sell a single, and that's selling a call option in this market. And you should be collecting the same number, but you're collecting the bid, not the ask now, right? Because ask is for when you buy the option. Now the bid is slightly lower. The ask was 218. So that's what we call the bid-ask spread. The bid-ask spread here is just 5 cents. It's very tight, and meaning the market maker will buy this off you for 213 and then sell it back to you for 218. That's the difference basically. But look at the probability of profit. So you select your break evens again. Now look at the gray area, right? You have a 70% chance, 77% chance that this underlying stock will make you money, meaning it will stay within this range, which is your range. Your range is just slightly out of this, the total range here. Meaning if the stock stays here, all the way down here, you make money. How much? Max you can make is $213. In the other one, the long call, the max you could make is infinity because the stock can keep going up and up. There's no ceiling to it. But here there is a ceiling, meaning you can only make as much as you collect. But the difference is you can make this much more number of times and more frequently, not frequently, but more with more confidence and a higher probability that of making this money. Whereas on the other side, you only had a 40% chance of making that call option work in your favor. So that's the major difference. The Greeks that you collect here are short delta because you've collected the actual Greeks are basically here in the middle line. So you collected 27 delta or 28. We sold it at 28. So that's how many delta you will collect on the short side. So you're collecting negative delta here, right? Short gamma, very small, not a problem. Theta is always positive for you, meaning when you sell an option, the theta is positive. On the other side, when you are buying an option, theta is always negative, meaning every single day that passes on, you will lose money by just holding that call option. That's the cost of carry on the long side here. When you buy options, that's the cost of carry. You're short vega, meaning the volatility has to come down for you to not get hurt in this position. That's why we sell options when the volatility is high. When it jumps up, we sell options. When it's low, we get into different strategies, still with positive theta, but then with positive vega, meaning we do calendar spreads. We do some other kind of structures which keeps us within the game of positive vega when the volatility is on the low side. Okay. And the reason I say that is because if you look at the VIX chart, the VIX chart has a average line at 15, 16. That's where it trades. It doesn't go beyond that. Whenever it does, it comes back down. So let's look at the chart of VIX. This is another reason I want to show you why we do what we do is look at this chart of VIX. So volatility is a mean reverting asset. It's the only mean reverting asset, by the way, which whenever it goes up, it comes back down. Whenever it goes up, it comes back down. Now, what does this mean? This means that when it goes up, we sell options here because now the premiums are juicier. And when it comes down, that's when we make money because we have negative vega in the, in this chart, in the volatility. In selling options, we are negative vega. So we make money when the vol goes down. So that's the main game here. Okay, now I want to show you the short put here as well. Let's just do the same thing, a single at 30 delta on the put side now, and take this to the analyze tab. It'll be the exact same thing like the call option we had, the short call option, but it will be, the Greeks will be slightly different. So take out the call. By the way, when you sell a call and a put, that becomes a strangle, and that's what this is. This is a strangle position. At 30 delta, you have completely flattened out your delta, meaning you're one side you're positive, one side you're negative. Similar amount of delta, so it's completely negative. It's completely flat. But we're not looking into strangles right now. We're just looking at a short put. Okay, so this is a short put. You have to select your break evens and go here. Look at this number, 74% chance of winning, meaning the theoretical number for this underlying to stay within this gray area is 74% from now till the end of the expiration cycle, which is about 18 days out. Okay, so this is the reason why we sell options, because we get a better probability of profit, meaning we get a better chance of making money. Yes, that money is small and the risk we're taking is a little bit higher, but we know how to manage that risk. So as long as you know how to manage that risk and not get burned out, you can make this kind of you can take small profits more number of times than just losing money on when you buy the option. When you buy the option, you don't have any other option to just close it out if it goes against you. But here, you have the option to roll it out in the next expiration cycle, keep, select, recenter your strikes, move the strikes up and down the chart, up and down the cycles, move further out in time, just to stay within the game. That's the whole idea. What else do I have here? So I've shown you the short call, the short put. Now, just to recap the main differences here, the risk on the buy side is limited. You just pay the debit and then you move on. Either you lose the debit or you make some more money on top of the debit, and then you close it out and you move on. Whereas on the selling side, when you sell naked options, there is unlimited risk. I agree, but then our main strategy is to sell credit spreads, and the idea for credit spreads is that you define your risk on the downside, you define your risk on the upside, and then keep taking those small wins, and then just keep rinsing and repeating like that. You can go through these. I'll put the slides in the show notes as well. Probability of profit is really low on the buying side. It's really high on the selling side. Capital requirements are low on the buy side. Obviously, you just pay the debit, and they're high on the selling side, but not that high. When you do spreads like credit spreads, it's not really that high. Common strategies here is your long puts, long calls, straddles, cover calls, cash secure puts. Okay, this is similar, but I thought this was slightly different because this slide was talking about more Greeks. So time decay is against you when you buy options. It's with you when you sell options. Vega we've already discussed, and margins we've already discussed. Okay, what's there? Key risk. Time decay is obviously the key risk. You lose money on theta every day when you buy options. You make money on theta when you sell options. and volatility is positive when you buy options, and therefore it's negative when you sell options. So there is assignment risk on the sell side, yes, but we know exactly how to manage that risk. We don't really get too close to the money. We don't really get too close to expiration, so we don't get assigned. In my 10 years of trading, I've never been assigned, basically. That's the whole idea. Again, take a look at this, how the premiums work, what are your break evens for all four of these. Final takeaways, let's discuss that. If you're a beginner, I would start buying options, yes, in my paper trading account, just to get the feel of it, like how it works. And then once you have taken up, at least 10, 20, 30 trades on the buy side, then you start moving on to the sell side, and then you start doing some spreads, or cover calls on your positions, and start dipping into this short side of the market. So that's all I have for you. Take a look at the webinar I posted here. But then once you're done, if you think you're already out of that beginner zone or intermediate zone, and you need more practice, more details, more deep dives, I do run a 5-day trading cohort. The next one is in July. The dates are here on top. Take a look at this page. This is exactly what we will cover together, because we will be on the journey together. So we will cover some basic stuff on the Greeks. We will do 4 live trade setups in 5 days. I will show you how to manage the trades. I will basically show you exactly what I've learned in the last 10 years, so that you can go on and do it for your, in your account, or, do it by yourself. Whatever I've learned, that I can just transfer that knowledge, to you on options trading, so you can start making some monthly consistent income. The goal is to make consistent income, not make money here and there and then lose, and fund your account again and keep doing that. So we will do 4 live setups. Deep dive into credit spreads. That's our bread and butter here on Scales. That's what I do most of the time. It keeps I don't wake up at nights to check my account, because I sleep well. I know exactly what my max profit and max gain is before going in, and then how to manage these trades. We will talk about some advanced tactics, how to roll, how to manage, how to cut down on your delta, or your manage your Greeks, or just basically how to run an options trading account. Small account, not a big account. That's totally fine. I run a $5,000 to $10,000 account. That's totally fine. You can start with that. There are plenty of things we can do in the market with $5,000 to $10,000. Trust me, if you cannot make money on 5 to 10, you will not be able to make money if I give you $100,000. So don't worry about the money, or how small your account is or whatnot. We'll go through some advanced tactics, and then there are some takeaways. I'll give you some checklists to go through, some position sizing calculators, repair flow charts, and all that kind of stuff. A lot of bonuses come with it. The top 10 signups get a one-on-one call with me on the review call of their account, of their total fund size, fund with a portfolio, whatever it is. I'll take a one-on-one call for the first 10 signups, and we're only limiting this to 50, because I want to keep it small, and just to make sure that everyone gets the attention and the knowledge that they need, and the time basically that they need. So take a look at this. I hope you enjoyed this video. Just let me know in the comments if I should be doing whatever you are thinking about, struggling with, having a good time with. Just let me know, and I'll try and make some content around it. So thank you very much for watching. Hit subscribe if you like it, and I'll see you in the next one. Thank you very much. Bye-bye.